Again, I'm Shannon Peer from the Colorado Foreclosure Hotline and managing the Housing Counseling Department, Brothers Redevelopment. We did this just a few weeks ago, and the perspective that I want to talk to you today is as though you might be helping somebody else with this information. And that is partly because some of the folks that attended last time were coming on behalf of other people or wanted the information to be able to pass it on, and some others were here for their own personal reasons. So feel free to please interact with me and let me know if you have questions along the way. I'd be happy to address them as we're going through the presentation, or even after. We're going to have several minutes to do maybe some what-if questions or some specific scenarios that I might be able to help explain or give you some information and provide you with resources on. So, Foreclosure Hotline, obviously, the logo itself provides the number 1-877-601-HOPE or 4673, and we do have some brochures in the back. This is a little bit about the expectations for the presentation today and our discussion. We're going to talk about the foreclosure process. We're going to talk about budgeting, which is a huge aspect of foreclosure prevention. Work out resolutions. What are the possibilities once somebody has fallen behind, or if they know they're going to fall behind shortly? What can be done? We're going to talk about discussions with the mortgage company and how those tend to go, what you can do to improve your communication with the mortgage company or a homeowner's communication with the mortgage company. Challenges that a homeowner typically faces when they're working towards a solution. So it's not an easy, you fill out a form and you get your work out. It's as much as we would like that to be the case, it's not the situation. How can a housing counselor help? Well, so we'll talk a little bit about housing counseling. There are free housing counselors that if you called the Colorado Foreclosure Hotline, you would be connected to a local housing counselor, counseling agency and counselor to meet with face-to-face if you want, or over the phone, and maybe get some assistance and some guidance and a plan of action, maybe a budget review, and maybe even help communicating with your mortgage company. And then of course we'll have some questions at the end. This is the Colorado foreclosure process. Each state within the United States has a different process, but this is ours, and this is the one that we're concerned with. And you can see that it goes from the first missed payment on January all the way to September before an actual foreclosure sale date. So we're talking about 6-7 months of missed payments before an actual foreclosure sale happens. Sometimes when somebody misses a payment, they get a call from a mortgage company collections representative, and they make it sound like they're coming next week. It's not the case. The anxiety level usually spikes at that point in time for a homeowner, and it's just understanding the timeline and the process usually helps somebody calm down and say, oh, look, I've got time to address this. And that's the case. We're kind of right in the middle of the different states and the timelines with our segment of time for the foreclosure process. Some states are shorter, as a few months as 2 months for a foreclosure process. Some much longer, as in 12 to 14 months. But plenty of time to resolve a situation, work with the mortgage company, or work towards some solution of a default or a missed payments. So within the foreclosure process, you've got, this timeline encompasses a couple of different things. So the area of the mortgage company, that's the colors. So general servicing. So you're making your payments on time, you ever call your mortgage company to ask a question, you're going to talk to the general servicing or customer service department. Okay, that's going to be the case even after you're about 15, 16 days late, before you really missed that first full payment and you're reported to the credit reporting agency. Once that happens, once you're 30 days late, they're going to report the delinquency to the the homeowner's credit, and then the collections department starts to get involved, and then they start to call, and they start to, their assumption is that you've got the money and they're just trying to make you pay, whether you have it or not. That's in order to do their job, they have to make that assumption. Sometimes they're not so nice. They may ask you to look at your see if you're married, look at your finger, do you have a fancy ring on, can you hawk it, can you get the money, can you pay for it? They come up with some very creative solutions, or they'll try to help you with those that may not be in your best interest. You may want to pursue some other ones. Not until you're about 90 days delinquent or late, excuse me, will the loss mitigation department typically get your file, get a homeowner's file. And the loss mitigation department is the department that holds the keys, the real options for avoiding foreclosure. So everybody heard about loan modifications? Been in the news quite a bit. There's repayment programs. We're going to talk about the options in a bit, but those usually come from the loss mitigation department. The reason they show up and start to work with homeowners at about 90 days of delinquency or missed payments is because the majority of people do catch up on their own if they're only 30 days or maybe even 60 days delinquent. They had an unexpected expense and now they're able to catch up. Once you get 90 days late, that's 3 mortgage payments. That's a big chunk of money to come up with and catch up on your own. So that's when the loss mitigation department comes in and says, okay, homeowner, we're here to help you manage getting back on track if that's what we can do. And then of course that loss mitigation time period and some of the state-specific activities within the process, the notice of election demand, which is the attorneys have become involved from the mortgage company, public trustee for the county is now involved, and they're processing the foreclosure at that point. And then of course a sale date towards the end of the period, whereas the home is sold to either the highest bidder or which could include the mortgage company themselves. And at that point in time there's an eviction process that happens that most homeowners aren't aware of. They think that sale date is it and they're going to have to be out, but there's an eviction process, and there's sometimes still some options to receive some type of cash for keys or assistance to move from the mortgage company, which is usually unbeknownst to the homeowner as well. So, any questions on the foreclosure process? No?
Actually, I have one. Can that timeline kind of be extended?
It can, yes. There's actually a state-specific program called the 90-day deferment, the Colorado deferment program. Once the notice of an election and demand has been filed, there's a posting that goes on the homeowner's door that gives them the opportunity by way of calling the Colorado Foreclosure Hotline, meeting with a counselor to see if they qualify for a 90-day deferment. So this period could be extended by 90 days if the homeowner qualifies. And also, outside of the state-specific legislation and program, at any point in time that the homeowner is communicating with a mortgage company, if they're still under review for some workout, that sale can be postponed. Very much so. Now, what's tricky is that it's typically not postponed more than 12 months past this May period where we're talking about the notice of election and demand. So a couple of months, yeah, that's not a problem. We see that quite often. Yep, good question. The budget. All right, well, this is where the rubber meets the road. Review of the household budget is the first thing that a homeowner should do when they're realizing they're going to miss a payment or they've realized they've missed a payment, because determining what the expenses are, comparing to the income, and really trying to pinpoint the problem. The mortgage company is going to need a budget. They make financial decisions. That's what they do. There's no emotion involved. There's no I hope it looks this way or I hope it looks that way. They work off of a budget. They need proof of the budget too. So income, they want proof of that income. So they also, on certain expenses, they're gonna check credit reports. They're gonna see those expenses that are reported to the credit reporting agencies. It's important for the homeowner before calling the mortgage company to have a budget worked out. Winging a budget off the top of your head is the worst thing you can do when you're talking to a mortgage company. And 95% of the time you call it, if a homeowner calls a mortgage company, the first thing they're going to say is, okay, well, let's take a look at your budget. What's your income? What is this expense? What is that expense? They're going to go through all the different potential expenses because they want to know the picture. And if a homeowner gives a budget that is not quite accurate, the solutions aren't going to be as good. They're not going to be as tailored to the real problem. So don't don't let a homeowner provide a budget off the top of their head. Work out resolutions to keep your home. There are two ways to avoid foreclosure: keeping your home and liquidating your home, or getting out from under the home. Okay, so we're going to talk about the keeping your home. A repayment program. If a homeowner has missed a payment or two, or a couple, the potential for a repayment program to catch up and become current again is one of the better solutions in the long run for a homeowner. But there has to be enough income to do so, because you typically pay your normal mortgage payment plus a portion of what you're behind in order to catch up. So the homeowner has to have recovered from the hardship in order for a repayment program to really be a solution. If the income has dropped and there's no increase in income in sight, repayment programs are probably not the best solution. Special forbearance. That might be a forbearance of payment, or a lesser payment or no payment for a short period of time to allow for a homeowner to get to resolve and to get over their financial hardship. This sometimes is the first step in a couple of steps solution if the homeowner has not recovered from the hardship that they experienced that created the deficient amount in their budget and a missed payment. Loan modification, that's the most popular and most discussed in the media these days. The Making Home Affordable program, which is through the Treasury, has been around since 2009, 2008 now maybe even. It's been around for a while, and so loan modifications are discussed all the time. And what happens in a loan modification is an adjustment of terms that were originally agreed upon in order to catch somebody up or to reduce their payment to make it affordable so that they can stay in the home. Now, an example. Someone has missed 2 payments and they need help getting caught back up. They've recovered from their hardship and they're now, let's say they were unemployed 2 months, now they're employed, but they can't catch up that 2 months delinquency on their own. So a modification could help them take that 2 months that they owe, put it back into the loan, and readjust the loan payments so that they would be current and then move forward with an existing payment. Sometimes it's a reduced rate to bring the payment down, but the focus of a loan modification would be to get the payment, get the loan current, and to get the payment to an affordable monthly payment that the homeowner can afford moving forward. Does that make sense? FHA partial claim. If someone has an FHA insured loan and an FHA insured loan, they have additional options outside of the traditional options that a mortgage company would offer. And one of those is an FHA partial claim, whereas HUD would actually pay the amount that's delinquent and put a second mortgage or a third mortgage position against the home, but the homeowner wouldn't make a payment towards that loan until they actually sell or refinance.
Quick question.
Uh-huh.
It is in reference to that loan modification.
Sure.
You know, it all sounds great and everything, but when you try to get into that, you've got to pay like some kind of attorney fees. So
Depends on where somebody is in the process. If they're attorney's fees, then they're farther on in the process than normal, yes.
And they basically will tell you not to make any payments, just go ahead and pay the attorney fees, and then they promise you these great refinancing options. So it's like, I don't know, that just seems kind of odd that, and then they also say that it goes on your credit report worse than like a bankruptcy.
Mm-hmm. Something that happens quite often, and it's the mortgage company representatives feel that they're helping the homeowner by telling them that they should miss payments in order to qualify for a mortgage loan modification. That is not the case, because when somebody misses a payment, there's only one guarantee, and that's foreclosure. There's no guarantee you're going to get a modification. There are a lot of different hoops, as you said, that there are a lot of changes that they might not be positive changes as well. So yeah, unfortunately, we've heard that homeowners it's been implied to homeowners they should miss a payment, or even direct just communication. You should miss a payment and then we'll qualify you for a loan modification. Well, number one, the process is very long and arduous. And again, there's no guarantees. But if somebody is inevitably going to miss a payment or has missed a payment, and you get to a point of where the fees are adding up, yeah, most of the time there is some type of pay into the loan modification. But again, if there wasn't a payment being made, hopefully the homeowner has been able to save something to go towards it. And sometimes those fees are rolled into different fees, or depending on what the fees are, they're rolled into the loan, and so the principal balance goes from here to here, and that's a negative in some homeowners' eyes as well. There is a lot to consider when thinking about a loan modification. In the media, it does sound like a very nice way to reduce your rate. That's a very slippery slope if somebody is looking to just reduce the rate by doing a loan modification. And in that instance, because there are so many what ifs, often have asked to have a housing counselor review the situation to see. Housing counselors are very good at, and we'll talk about them a little later, but they're very good at looking at a homeowner's situation to even determine, okay, well, we do this every day, and the mortgage companies aren't going to provide you with a modification in this situation. They can pinpoint when there's a likelihood or when there's an unlikelihood of a modification, and to describe the what ifs. So even getting into the modification, what are you looking at? Right, and so you're right, it's not as bright and shiny as everybody tends to make it out. And unfortunately, that's why housing counselors are around it and so busy right now, is because it is not an easy process for a homeowner. I'll tell you that a homeowner can do it on their own. They can. But they have to be very persistent, and they have to do a lot of research. And they have to be able to make some educated decisions and financial decisions as well. Question?
Yes, I do. For the loan modification, also the FHA partial claim, having a past bankruptcy, doesn't that blow you out of the water for help for any one of those?
It depends on where you are in the bankruptcy process. And I'll tell you that the rules for the different programs are changing all the time. And they've gone in the direction of helping to allow for somebody that's experienced bankruptcy and gone through one to become available to get into those programs. I'll tell you that in the industry we always hear, well, this is possible, but when it comes down to what do you actually see, that's a different story. So, according to some of the guidelines, experiencing a bankruptcy and still being able to get into loan modification is possible. We don't see it very often. But again,
down because of that.
Right, but there's again time frame. It depends. Bankruptcy is definitely an agent that muddies the water with regard to foreclosure prevention. I can tell you that we have seen homeowners that have filed bankruptcy during the process and kept their home, but that's not necessarily the case for everybody. And it's tough because our housing counselors they're not attorneys, so they can't really guide you into what you should or shouldn't do. That's an attorney that's going to have to provide that information, but it can be an option. Okay. Deferment. That's the 90-day deferment that we talked about a little earlier. If somebody is in the active foreclosure process, whereas the attorneys from the mortgage company and the public trustee are involved, that there is a posting on the door with an opportunity for a 90-day deferment to allow a homeowner to work with their mortgage company to get a resolution to avoid foreclosure. And that is a state specific. I don't know of any other state right now in the United States that offers that to residents. Refinancing, obviously refinancing is an option if you are looking at the situation prior to a real income hardship and prior to missing a payment and having had good history. I'll tell you that homeowners that are calling the foreclosure hotline, very few are able to refinance out of the problem because they've already missed a payment in the last year, or the income has dropped and so they're not able to, or something in the past that there's some adjustments in a program recently that might address this, but something in the past has been somebody owes more on their home than it's worth. You're not going to be able to refinance if your home's worth $120,000 and you owe $140,000, because the bank's not going to give you $140,000 to refinance. But there is a new, it's not a new program, it's an adjustment to making home affordable suite products, I guess you'd call it, which is the HARP, Home Affordable Refinance Program, whereas they will allow you to refinance up past 100%. And the cap used to be 125%, and now they've removed that cap to where even if you're more above that. And the applications for that program is supposed to start December 1st, moving forward. And so we'll see whether that's actually going to open up an avenue. But again, the payment history must be good in order to qualify for that refinance product. Specifically, no missed payments within the last 6 months, and no more than one 30-day late payment within the last year. A reverse mortgage, so anyone that's 62 years of age and older and has enough equity in their property could do a reverse mortgage to avoid foreclosure. It does happen. We do see senior homeowners that didn't realize they could access a reverse mortgage and refinance out of a problem. Okay. Oh, bankruptcy. I didn't see that switch. Bankruptcy, as we talked about, it's a problem. It's a solution to the problem as well. Really, what bankruptcy can help address some non-housing problems and then allow you to address the housing problem. Typically, that's the situation. If somebody is filing bankruptcy specifically to save the home, usually what inevitably happens is they are buying time in the process, that they don't end up saving the home. I'll say that you know, sometimes homeowners will come in and they'll have more personal debt and non-housing debt that they'll be able to file bankruptcy for and resolve that, which would then get their budget in line to qualify for a modification. Again, there is a process for that bankruptcy, and whether that process timeline matches up with the foreclosure process timeline, that's the tricky part of juggling the bankruptcy as a solution. Workout resolutions to leave the home or to liquidate. Obviously, a full sale. If you have equity, if the homeowner has equity and they have the ability to sell to avoid the foreclosure and protect any equity that they have in the property, you know, a sale of a property is not just something that can happen in a week. There needs to be some prep time, and there needs to be some time to actually get a contract and to sell the property. So it can't be done a week before the foreclosure sale. So that's an option that somebody should, obviously, I would say most people want to keep their home when they've started the foreclosure process. So this is an option that is looked at second, or unless somebody specifically wants to get out from under their home while they're in the foreclosure process. But a full sale is just a traditional sale, and you can sell the house at any point in time between your first missed payment and the sale. No problem. Nobody needs to agree upon anything but you and the purchaser. Short sale, both FHA and conventional have that option. And what this means is really that you're selling the home short of what's owed to the bank. Now, what's the challenging part of this is that the bank has to agree to that. And there's a process, and it can be a long one. And depending on your loan, depends on different steps that you might take, that a homeowner might have to take in order to get an acceptance at a price that's less than what's owed to the homeowner. When we're talking about a short sale and a couple other options here in a second, there are some consequences. So if the bank is letting a homeowner free of a certain dollar amount to sell the home, the bank has two options. They can either come after the homeowner for the difference by suing them, by filing a judgment, or they can write off the amount that was not paid to them as a write-off, a tax write-off. But then when they do that, the IRS sees that write-off as income to the homeowner, when the homeowner might have to pay taxes on it depending on their situation. There is some legislation that has allowed for homeowners to be relieved of that burden as long as there are certain things in place and the homeowner meets the qualifications for that relief. Now, what's interesting is that the discussion usually is, well, if they have the ability to do that, why wouldn't I just let it foreclose? Well, they have the same opportunity when they foreclose, when the bank forecloses, to come after the homeowner for the difference, or to write it off as taxes, and the homeowner is liable for the difference as income, taxes on the income. If you're doing if a homeowner is doing a short sale, they're damage controlling. They're taking care of the property while they're there without a long period of time of potential vacancy, whereas deterioration can happen rapidly and in a greater amount to where the deficiency to the bank would be much more. So let's say that a homeowner looks, while they're in the foreclosure process, they look at doing a short sale when they're 3-4 months delinquent. They're still in the house, they're still maintaining it, water running through the pipes, heat's still on, lights are still on, all that. Well, if they were to sell it for $20,000 less than what's owed to the bank then, compared to if they were to let it go, the amount of deficiency from 20,000 might grow to 40, 60, 100. Who knows how long it's going to take the bank to get it on the market, to get it sold, what's going to happen to the landscaping, what's going to happen to the property and the pipes and the roof and the plumbing and all the different, the electrical and animals getting in it, and vandals getting in it. The homeowner's still on the hook in the end for the deficiency. So in a counseling, from a counseling perspective, it's a damage control option to prevent the amount of loss that the homeowner might be liable for. Deed in lieu, it's a second step to having already attempted a short sale, whereas the mortgage company might actually just take the deed back in lieu of foreclosing within the foreclosure process without having to go through that full foreclosure process that we talked about earlier. But very rarely is the deed in lieu ever offered before a homeowner has attempted a short sale. Cash for keys. This has actually evolved over the years as well as some of these other workout solutions, but cash for keys, if the foreclosure actually happens and a homeowner is faced with an eviction or having to vacate, because when the sale happens in Colorado, the home is no longer owned by the homeowner, and they are at that point in time trespassing, squatting, what have you, but yet there is an eviction process. A lot of times the mortgage company is going to send a representative out and try to negotiate something of a vacating of the property without having to go through that eviction process. It's really the right thing to do by the mortgage companies. You don't necessarily see them always doing the right thing, but it's an option that has become acceptable and part of their practices over the years. And they might send somebody out and say, okay, well, we're going to give you 30 days to vacate the property in a broom cleaned condition, meaning that everything's out of the property, out of the house. It's not trashed, the cabinets aren't off the wall. You know, it's just kind of, doesn't have to be spick and span, but broom cleaned, trash up off the floors. And they'll provide a dollar amount, a settlement of sorts for the homeowner to move forward. And that could range anywhere from $200 to, quite frankly, we've seen one that was $10,000. Not uncommon for it to be about $1,500 to about $3,000. That's the average that we see. Talking with your mortgage company, not always the easiest of tasks, and typically a very scary and emotional situation for a homeowner. Remember to take notes. This goes true with any large company that you work with, maybe it be the energy company or the the phone company or what have you. And here's where homeowners can probably take some tips that they've learned with working with other large companies and apply it to a mortgage company. And that is, take notes, know the name of the people you're talking to, know the number that you called, so that if you need to get back with somebody, if the homeowner's calling and they get transferred, collecting the number that they're being transferred to, because I worked for a phone company once, and I transferred a lot of people that didn't make it. and I've been on the other end of it too, where I was a homeowner being transferred, and the call did not go through. And I had to start the process over again rather than calling the number that I was actually being transferred to. What department did you talk to? Was it the loss mitigation? Was it the collections? Who did you speak with? We talked about that. Where are you being transferred? Does it sound like if they're telling you they're transferring you somewhere, does that actually sound like where you should be transferred to? It's amazing, whereas a representative may just be wanting to get to the next caller and they're trying to transfer you. They don't really know where they're transferring you or know where they should be transferring you, but they may be saying, I'm going to transfer you to this department. It may just sound completely off.
So the first step in talking with your mortgage company, the introduction, what would the dialogue be? I mean, is there somebody I can talk to about assistance? I mean, how would you start that?
Yep, I would start off with, I need to speak with somebody about an upcoming missed payment that I'm about to miss a payment. Who should I talk to? I've missed 3 payments, and who should I talk to? A lot of times, the representative, before you'll even have that ability, will take your loan number and then say, this is where you're going. So remember when we had that timeline, we said that the general servicing, you would be talking to them if you called in and you were less than 30 days or maybe just over. And then from there, it might be collections agency from 30 to 60. So a lot of times they're going to try to direct you to that department, but be open about what it is that you want to talk about. And especially when it appears as though you've gotten to the right place, be clear about what it is that you're looking to accomplish. And as we know, different mortgage companies have different timelines and processes. Let's say Chase may not actually get the loss mitigation department involved until somebody's 120 days past due, which means you'll probably be talking to customer service or collections up until that point, which can be fairly frustrating.
And you can be so specific and say, I want to talk to somebody about, the deferments.
Modification, deferments. Deferment's going to be the housing counselor, but short forbearance, short sale. Yeah, you can be as specific as you would like. Again, a lot of those options are going to be offered by the loss mitigation department. Some of them call it the home retention department. The name has changed over depending on the servicing bank, but loss mitigation is kind of an umbrella term for those departments. Something else that you may take from calling a large call center is that if you get somebody that doesn't seem to be having a bad day, hang up and call back. And it's not a bad idea just to see if you get the same answer. If you get an answer that you don't necessarily like, call back and see if there's somebody else that you reach that gives you a different answer. And think of a work environment. Somebody that's brand new is doing the same work as somebody that's been there maybe 10 years. And there might be some level of difference in the communication and the conversation.
As a rule, how good are they at keeping notes about all of those conversations?
They're supposed to on every call. They control the notes that go in there, though.
Yeah.
I'll tell you that derogatory notes will go in there right away if there's any derogatory conversation. We've had clients come in that said, well, I lost my cool and I said some racial things and they don't really want to talk to me right now. And of course not, because the representative pulls up the file and it's the first thing they see. And their tone and their approach is going to be completely different. And again, that's that emotion that gets involved of making a financial decision and conversation. But of course, they make the notes. Some things are going to be left, but for the most part, I think those notes are in there. They may not be as detailed as we would all like, and that's why it's best to keep your notes. Something new that those that have volunteered for the Making Home Affordable Treasury Program is there's supposed to be a single point of contact for homeowners. But that's being interpreted a little bit differently by each mortgage bank. So you might have a single point of contact, whereas they are the single negotiator to try to work out the resolution, but when you call in, you may not actually be able to speak with them. Everybody will just be referring to, we're learning a little bit about that because that's a fairly new, in the last 6 months, requirement. But it's going in that direction, which is a good thing because then you don't get the variance of, I talked to so-and-so and they said there's no help for me, and then I talked to somebody today and they said they're going to send me out a packet and it's all set and done. Who should I believe? So it's an attempt to reduce that. Did they make notes on your account about the conversation? You can ask them too. And if there's something specific that you want them to note, ask them. Say, can you make that bold? Can you write that, type that in red? I mean, make the request. Make it stand out. What's the resolution of the call? Something else beyond that is, I found out early on that if you ask, is there something else that a basic, simple question, is there something else I should know about this file? I'm amazed, you'd be amazed at the amount of information that comes out from that question. And shock and awe because you think, wow, why wouldn't you have thought that was important to me before? So simple questions, always trying to make sure that if you've got a question about what's happening, ask it. No dumb questions when you're talking to them. Even if they say something and you don't quite know what it means, ask them. Banks typically use a lot of jargon. And again, housing counselors can help you filter through that and understand what it is that they're talking about and some of the terminology. Ask for a loss mitigation representative and not collections. Again, that's going to be determined by the bank whether you're going to be able to speak with loss mitigation or not, or whether that homeowner is going to be stuck with talking to the collections department. The loss mitigation department is a specialized department within the mortgage company created to minimize loss of foreclosure. They're there to say, if this makes sense and we can prevent as much loss as possible by doing a modification, then they should be doing a modification. The servicing company typically is not the company that owns the loan. They're working for them. And so they're supposed to be protecting this asset or this debt that's backed by the asset of the house. Which means if they can keep the homeowner in there, get the loan performing again where there's on-time payments every month, they should be doing that. It's the department you want to talk to. Housing counselors sometimes have specific numbers that they can call to get a homeowner connected. Some important tips: be honest. Don't provide information that is not accurate and true. Don't hide information. Their mortgage company is going to be invasive. They're going to make this look like you're qualifying for a new loan. They're going to ask your assets, checking accounts, balances, savings accounts. They're going to want all of it. And in our experience, the more honest person gets the most appropriate resolution. Sometimes we've had homeowners that don't want to divulge their full assets, like that they own a $100,000 motorhome maybe, and so they don't want the mortgage company to know that because they want the best deal. And quite frankly, that's kind of taking advantage of the system. Housing counselor's not going to help a homeowner take advantage of the system. They're just going to help a homeowner who wants to be honest and wants to get through a tough spot. And I'll tell you, people trying to take advantage of the system don't usually end up in the situation they had hoped to be in the end. When circumstances change, like say income increases, even though you may be currently, or the homeowner may be currently under review, update the income. It might help you. Follow-up is the borrower's responsibility. A lot of times the mortgage company will say, we will do this, but the homeowner should not take that as the truth. They should follow up. they should call until they reach somebody on the phone, leaving messages every day. Kind of the squeaky wheel gets the grease, and sometimes that's hardly enough, but doing everything that you can, and not relying on the mortgage company to live up to their agreements. Do not wait until it's too late. And as personal and emotional as it may be for a homeowner to discuss it, if they actually talk to others, family, friends, there might be a resolution that comes out of it. We've seen some great resolutions come out of just somebody talking to their neighbor. Maybe the neighbor has a job that they've been trying to hire for a month, and the neighbor fits that bill. But if they're not communicating, they don't know one needs the job and the other has the job. So it's kind of the more heads that you put around the problem, the better off, the better solution potential from that. Don't agree to just anything. If it doesn't work for your situation, and it's not uncommon for a bank to provide a modification that just, I don't know how they got to the modification that they came to, but usually it's because of improper information input. So they think that the homeowner has some income that the homeowner didn't provide, or it's just off somewhere, the communication was wrong. And so the modification is just, the homeowner can't afford it, but they feel like they need to sign it, and they need to get it because it's being offered. It's not the case. It's not the case. What the mortgage company needs from you: a hardship letter explaining what the problem is. Typically, it's what are you looking for? What happened? Where are you now? And what are you looking to accomplish? What would you like them to help you with? Financial worksheet. They usually have their own. Each mortgage company has a specific one. You can usually get them online. Should be signed and dated. They usually have a list of documents to provide, including tax filings and such. A little trick that we've learned is if a loan number is at the top of every page, the likelihood of the full packet getting to where it needs to be complete is much greater. Loan number, name, property address, as much as you want to put at the top of each page, so it's identifiable that this page goes with this page, goes with this page, and then that it's a packet. Pay stubs, proof of income, bank statements, tax forms. Challenges faced with working towards a solution: well, lost paperwork, not uncommon, and that's where persistence pays off for a homeowner. You know, if you have to send it in 4 times, so be it. Just be persistent. Don't wait 2 months if they to find out that they didn't get it the first time. Inconsistencies among mortgage company representatives, communication errors, whereas a certain amount of income was put in when that's not the real income. We find that one quite often. Homeowners have to go in and make sure that those are updated. Borrower paperwork is incomplete or missing, and so they'll close the file review without hardly saying a word of, hey, we need this document. So persistence again. Is that right? No, but that's just kind of the world that we're living in. And there are attempts that are out there to change it. And what we do is help the borrower work within the system that exists and try to change it on our own. And that's why we've gotten certain relationships with different banks, because they realize that's not right either. But they realize, some of them realize they can't necessarily change it overnight, so they'll help us with certain files. So communication barriers is the biggest problem. Plan of action. Every homeowner should have a plan of action in this situation. And whether you do it yourself or you have somebody help you with that plan of action, educate yourself, organize yourself, and then do the work. How can a housing counselor help? Housing counselor does this on a day-to-day basis for homeowners, and so they can educate the homeowner with the different options, where they are, help them pinpoint where they are in the process, what their budget is, some creative ways to resolve the problem. There may be programs in the community that homeowners aren't aware of. Some loan program that might be available to the homeowner. Bridging the gap in communication. It's amazing what a third party, an unemotional third party, can do when two parties are communicating. It's amazing. Counselors hear all the time, you just did in 15 minutes what I've been trying to do for 3 months. And there's no real magic except for there's an unemotional third party translating and bridging the gap between the other two and making sure that it's efficient communication. Providing the borrower with resources. We are, housing counselors aren't the end-all be-all for housing resources, but we know a lot of resources in the community. We can point homeowners to those if what they need is outside the scope. Assisting in submitting the loss mitigation packet, we can help you package that and get it complete and have it put in for a full review.
Is there a cost for a housing counselor?
No cost. Housing counselors, HUD-approved housing counselors are free, and all of the agencies that are part of the hotline network, the Colorado Foreclosure Hotline network, are free, and they are HUD-approved agencies, which means that we follow guidelines set by HUD. They come in and they do reviews and audits on a regular basis and reapprove the agency based off of their compliance. Are there any other questions? Any really specific questions? Any general questions? Questions about resources? There are a lot of scams out there. Those that are posing as people that can help, but if they're not HUD-approved housing counseling agencies or nonprofit agencies that are working towards HUD approval, they have to be getting their funding from somewhere. And so for the most part, they may say it's free, or maybe it's an attorney that's saying that they're going to help you submit your loss mitigation packet. Sure, they will, and they may only do that, but they're charging you $2,500 to do so, and you don't get much more you don't get as much as you think, and a lot of them will take your money and do nothing. So we work with the Colorado Attorney General's office, Department of Regulatory agencies to help spread the word about different scams. You know, one of them that came about recently, Channel 4 did a report where a homeowner had gotten a call from somebody saying, hey, we can help you apply for a loan modification, and oh, by the way, why don't you stop making your mortgage payment to your mortgage company and make it to this company, and then we'll work towards getting you a modification. That doesn't sound like good advice to me. That's an old scam that kind of went away for a little while and now is resurfacing again. Don't ever pay anybody other than your mortgage company. So housing counselors can usually help you filter through that. And a lot of times, foreclosure, once a homeowner is in foreclosure, their information becomes public. And so very often are solicited by these scam companies or fee-for-service companies to get the business. And not many are very reputable or action-oriented.
Shannon, how long after someone calls the hotline will a HUD-approved counselor get back to them?
It can range anywhere from they answer the phone when the homeowner calls to 24 to 48 hours. It just kind of depends on the agency that they're going to be connected with, the call volume at that time as well. So within a day or so. And we always have a representative during office hours at the hotline to be able to speak with to make sure that they've been connected with the right person. Was this helpful? Yeah? And again, we're happy to provide additional resources for community agencies or industry-related, housing industry-related resources. So you don't just have to call to schedule an appointment with the housing counselor. All right, thank you very much.